I have the privilege of chatting with Patrick Enns, who's the president of goeasy, Easy Financial, and I'm super excited about that. Thank you so much.
Yeah.
So on this session, we're going to plow through certain questions, but if we have time, I'm going to take questions from the audience as well. So I guess to start off, you're sort of a new face. You're not a new face in the industry, but you're a new face at goeasy. So maybe just can you give us a little bit of background on yourself?
Sure, yeah. Great to be here, by the way. So I joined goeasy as president of Easy Financial July 2nd of 24. So a little over 15 months, 5 quarters ago. We count every quarter as a success. Before that, I was at Capital One for a long time, coming up on 18 years.
18 years,
and,
just shy of 18 years.
Just shy of 18 years, so I was about to become an adult, and I had to move out on my own.
No.
So I switched it up to Easy Financial. Yeah, it's been a great journey so far.
Yeah. So tell me a little bit about, I mean, shy of 18 years, that's a long time. What tools did you learn and bring over to goeasy? What tools are relevant that you had nurtured and built in 18 years that you brought to your new position? Yeah.
I mean, I just don't want to make it too much about that company, which is a great company, and there are people here from there as well.
Don't focus on the company, focus on the tools.
Well, I think what makes that company so unique is that literally in the year like 1987, they said, we see a data revolution coming, and we're going to leverage data and technology to differentiate in the credit space. And it's a company that's run by credit people leveraging data and technology to win in the market. So to spend 18 years in that environment, like that's a pretty good, awesome training ground, right?
Yeah.
And I think that organization is one of the best, in the world at that. So I feel really privileged to have spent as long as I did there learning like the fundamentals of what makes for an exceptional leader and credit leader in the financial services space.
Got it. So what's your day-to-day job now? Like what are you focused on with your role now? Yeah,
so goeasy's essentially got 3 brands: LendCare, Easy Financial, Easy Home. I'm president of Easy Financial and Easy Home, which is the retail direct-to-consumer business. That's our lease-to-own business. That is our brick-and-mortar network of our 400 locations. That's our personal loans business, the unsecured and home equity loan product as well. Got
it. So let's plow into change. Wow. If any company has changed over the last few quarters, it's you. You had Jason Mullins, who resigned. So you've onboarded a new CEO. Your CFO is departing, I believe. How's this all impacting goeasy?
Yeah, I mean, let's just acknowledge it is a heck of a lot of change. I mean, it was literally my second day on the job when Jason's departure was announced, and I did not know about it ahead of time. So, the guy I vetted as much as I could as my new boss was leaving. Now he stayed on for another 6 months. He's still part of the board. He literally texted me as I was walking up here and said, "Hey, see you tonight." So he's very much active and involved. We onboarded Dan Reese from Scotiabank in March, which was fantastic. We've got Hal Curry, who's been CFO. He's exiting at the end of the quarter, and we've onboarded Felix Wu as interim CFO. And I have the pleasure of knowing Felix for many years and have worked with him in the past. So, with change, there's been new talent that's come on board, and in the midst of all that change, I think the loan book's grown 20+%, and revenues exceeded 1.5 billion, and we're setting new records every quarter. So, it's just a great reminder to everyone that the business is bigger than the individuals inside of it.
Right.
We're completely dependent on our talent in a whole, but no one person is bigger than the business.
Yeah, but Jason was a loud and eloquent voice for the company and for the industry. So I guess it takes a little bit of time for folk to develop that voice and represent both the company and the industry. So how's that transition going?
Yeah, I mean, Jason's still so available, by the way. I mean, I was just connecting with him on Friday night about all the things that we need to be saying and advocating for in our space. And so he is still very much an interested party. He still has a ton of equity in our business, and he is still very much active, in our space. So I would say it's been wonderful in the sense that I can still lean on him as much as I had always wanted to lean on him, even though he's not part of the day-to-day organization.
Yeah. And I have, so everybody knows, I have him on WhatsApp, and he is very available all the time. So that's great. I want to start with elephant in the room, right? So recently you had some headwinds, right? And it's not just the change of roles. You had a short report from Jehoshaphat and research in September. So how did you and others sort of manage the company's reputation in that regard?
Yes, and still managing. So maybe everyone did or didn't see it, I'm not sure, but there was a short report that came out near the end of September. Yeah. And essentially it had the desired effect, right? Like the immediate aftermath of that was that our stock declined, I think 10% that day and another 10% the next day. And I won't name the company, but I was joking with someone else in the room who saw their stock do the exact same thing. So there was a little bit of a like, well, hey, we may not fully understand what this all means, but there's this natural skepticism about companies that are lending in the non-prime space, right? You know, so for us, a couple things. I mean, one is that there's only so much we can say at a given point in time. We are a publicly traded organization. When we make disclosures, we have to make them to everyone. So, you know, it gives us an opportunity through our next earnings call, which comes up in November, to be more detailed and ask more questions because that's our forum to disclose to everyone at the same time versus, you know, selectively between the short report and here. So really all we did at that time externally was share our disagreement with it through a press release. And then the other thing that I think we should also be really proud of as an organization is that like we have been scrubbing the heck out of that report too to say, what can we learn from this? Like, are there things that we should be taking away from this? And I think we've at least found opportunities in terms of how we communicate and position our business to clarify what appear to be some assumptions we didn't know were being made, right? So look forward to addressing those as well.
Yeah. So what I took from the beginning of that was that it didn't just it pointed a stick at you guys, but it somewhat blemished the reputation of the entire non-prime.
Yeah, you can look at other stocks that would be compared to us frequently, and you can see that on the exact same day, they seem to be suffering from the same fate. Now, this is certainly not our fault. We did not write said short report, right? But it's just interesting to see how much skepticism there is and how quickly you can touch on that. So, like, I think that's a pretty strong reminder to all of us that the most important thing that we need to do is continue to run our business exceptionally well, right? And as we are essentially a lender, so being exceptional at credit is what we do, and we have to do that day in and day out. And even though we've done that for many years, you can still have one person try and create a narrative or one organization that can cause people to have moments of doubt, right? So, it's a never-ending battle.
Yeah, well, we're going to come back a little bit to reputation because that's a leitmotif in the industry, in the non-prime industry specifically. But you know, I think it's interesting that you've managed to, I guess, ruggedize yourself based on the short report, and we'll be looking forward to seeing what you guys discuss on your quarterly. Last year, on this stage, I spoke with Jason Mullins, in a session we called Easy Does It, right? This session is called, you know, scaling with easy. Obviously, we like pithy titles at the summit. We strive for pithy titles, but how easy is it to scale in this market, given some of the challenges you have?
Yeah, I mean, I think one of the superpowers of Jason Mullins, since we're talking about him, is his ability to make things look easy, right? And his ability to make the growth journey look relatively easy for the organization. The first loan was given out in December of 2006. Which I can't help to think if it was December like 2004, maybe we'd have a different story up here, but not enough time to hit the gas pedal there before the Great Recession. And then we hit $1 billion in 2019. So that's like 13 years in between. You can imagine a lot of slog that happened in there, a lot of work to build out your underwriting, your collections, your servicing, your distribution, your products, like just a heck of a lot of work, right? And then from 2019 to June of this year, we hit $5 billion. So, that foundation is really what people have been able to build on for the last 6 years. And not to say the last 6 years have been easy, but you can imagine how hard those first 13 years were.
Right, right. And so tell me a little bit about, in that context, the product expansion, acquisition of LendCare, POS financing that you've taken on. Tell me a little bit about how you pulled Ali Mattel and his team in and integrated it. And maybe you can just talk a little bit about that.
Yeah, for sure. I mean, there's been several rounds of product expansion that really drove the growth of the company. I mean, the first was figuring out risk-adjusted pricing in personal loans, and that brought down the credit risk and cost of funds. Then the company launched a home equity lending product, which has been very successful and attractive for consumers who have home equity and want to borrow at lower rates. And then the acquisition of LendCare, which was, hopefully I got this right, April 2021. Yes, thank you, Mr. Rappel. Which really unlocked the merchant point of sale business, right? So all of a sudden we added an auto vertical, power sports vertical, retail vertical, health vertical, and the marriage of those two businesses was really the kind of capital stack structure, infrastructure that had been built out in goeasy being married with the merchant partnerships, relationships, and strategy there to really unlock just tons of growth, right? So those verticals have really been driving outsized revenue and balance growth for the company, but also brought down our risk profile through more secured lending.
Got it. And culturally, I know LendCare is in a different building still, right?
Well, we've got basically like a head office that was originally there in Mississauga, and then Pickering is where the LendCare office, right. And then we've got our meet in the middle ground in downtown Toronto as well.
Got it. And how does that work? How I'm just thinking geographically, but maybe I shouldn't be thinking geographically, but...
the 407 helps. I mean, so Ali, you mentioned Ali. Yeah. Ali Mattel is the founder and president of that business, and Ali sits on the executive leadership team. So does Farhan Ali Khan, who's the chief revenue officer of LendCare. And then we've essentially got shared horizontal teams as well, right? So the human resources team is serving the LendCare business and the legacy Easy Financial businesses. The finance team is serving the LendCare business and the legacy businesses. The risk team is serving LendCare, right? So really when we talk about the separation, if you will, like it's where there's important differences in how you manage the go-to-market strategy, right? So my business on the Easy Financial side is way more focused on how we interact with customers directly. Ali is way more focused on how we interact with merchants.
Right.
That's how you win in that space.
Right. But it's interesting because I know that you're all relying on Jason as a horizontal on the risk side, right? So that you've integrated a risk and other services horizontally across the company.
Yeah, and honestly, there's still way more to go there, right? Because like one of the, I would say, value adds that we haven't fully unlocked yet is that the more non-prime Canadians that we have relationships with across all our product verticals, we're collecting more and more data that should make us better underwriting across all of those product verticals. And we've done some work on that, but we certainly haven't fully tapped the potential of that.
And then the potential is cross-sell, or?
And then there's the potential for cross-sell as well. So today we largely keep kind of the brands separate, but that doesn't mean we don't offer the products across the brands.
Got it. And is that aspirationally where you want to get to, where there's fluid sort of product cross-sell, or is that?
Definitely the end vision for the company is to be a one-stop shop for credit for all non-prime Canadians, right? So stitching together that experience is the North Star that we're working towards.
Got it. So North Star, talking a little bit about the North Star, you've communicated externally that the company expects to be north of $7 billion by 28. So in the context of North Star, is that realistic? Is that something that we can expect?
Yeah, I think I might have misquoted that. I think it's 27 right now. Our kind of 3-year commercial guidance has us Call it the midpoint is $7.5 billion by the end
Okay.
of 27.
Okay.
We're about a $5 billion business. I think we were 5.1 at the end of Q2. We're adding about $1 billion a year in receivables right now. So it would actually be just consistent, continued dollar growth of the business. And if you're wondering how attainable that is, I mean, we look at the size of the market and say this thing's nearly $250 billion, and we're $5 billion. So it's less so about our ability to find the demand for the products. It's more about our ability to service the demand for those products. Yeah.
To execute on that. So you're gung ho. That number's attainable. Just chugging along at the rate that you're doing now.
Yeah, exactly. We think that if we execute very clearly on the verticals that we're in, we can do this.
Got it. So super exciting on the numbers. I know you guys really well because you're involved at the CLA on our non-prime roundtable and very active there with our other members. Sabrina and the team and Jason as well knows how busy the last 2 years have been. I had less gray hair 2 years ago, so it's been a busy year on the non-prime space. How can you not only scale, and I know you can scale, but how do you scale a non-prime lending business responsibly? And maybe this comes back to market perception. We have a very unique and challenging regulatory landscape. So how do you balance those two?
Yeah. I mean, Gary, you probably know this better than I do at this point because you've been on the forefront through the CLA on what the attack arguments would be. But I feel like they often go something like, your company is successful when your customers are unsuccessful, right? And there's some construct that gets tied together that says, you're winning at the cost of someone else. So a big part of it, of course, is the story that the CLA has been telling, which is, well, these are real Canadians with real challenges that have alternatives often to the services that could be provided by a company like ours or someone else's. And would you rather them get funding from a company that wants to help them solve their challenge and elevate their credit over time through a regulated institution, or would you prefer that they go a different route? And there are less regulated options, and there's even many shadow options, right? So I think in some ways we're not accurately always representing the set of choices that consumers have. And then we're certainly always looking for better ways to demonstrate the value that we provide to customers and how many of our customers actually end up improving their credit over time. And they wouldn't have been able to do that if a company like ours did not step in. Yeah,
but maybe, I don't know if you can do this, but can you just remind maybe the group of how many customers or the statistically, how many customers you are graduating?
Yeah, we look at it in a couple ways. I mean, so about 60% of our consumers see credit score improvement, and about 30% of our customers are able to open a prime trade after about a year with us. So those are like the two metrics that we stay focused on, and we try and tell our story. Often individual stories are more impressive than the statistics, or more impactful than the statistics, but those are the statistics.
Got it. Yeah, I mean, obviously grappling with this credit desert that we're creating in Canada between the APR cap that's been established at 35 and payday loans, which are in the background somewhere with loans in dark alleyways and the nefarious side of things. And the wider we create this credit desert, the fewer Canadians can actually graduate. And so that's this whole idea of perception, I think, that we're all grappling with in the industry. And so just to go back to that word of lending responsibly, is this something that's, I presume it's not anomalous to to your company? This is something the whole sector is grappling with from a reputational perspective.
Yeah, and so how do you define responsible?
Yeah.
I guess is the big question maybe that you're pointing at there, Gary. So, I mean, one is are we lending to people that can afford to pay us back?
Right.
That's probably like first and foremost the thing that we do, and the underwriting framework that we employ at goeasy directly matches how much money we lend to someone with an assessment of how much can they afford to pay us back. And that's obviously good for us because we need to be paid back, but it's also good for the consumer. And so in many cases, the consumer is getting less money than they would want to get from us. And then the second thing is that we have to be incredibly transparent and forthcoming with our customers about the costs associated with borrowing this money from us, right? And what we expect them to do as they repay those balances. So when you tie those two things together, I think those are the most crucial elements of the system from our perspective. And we have our 400 retail locations across the country that I think actually differentiate us a little bit in this, because it gives people the opportunity to sit down face to face and literally walk through the loan documents, ask questions, ask probing questions, seek to understand in a way that's a lot different than if you just went through an online process. That I think there was an interesting point being made earlier around like, where is it appropriate to have friction, right? Like we kind of create some friction in there, which also in some ways can bother some customers and cause some drop off. In other ways, it helps customers ensure they understand what they're taking up at the end. Yeah,
which is a good segue into sort of rejection that, you've got, it was Jan 1 with the 35% APR coming into place. Obviously, you can't approve as many as you would have prior to that date. I know that you probably, adjusted the model a little bit, before Jan 1, but are you seeing a significant increase in rejections since Jan 1?
Yeah, we had, so we were tightening up just leading up to that process, both because of economic weakening and the expectations that we would need to be tighter post Jan 1. So we did go through a fairly significant contraction at that time, both for new borrowers, but also for existing borrowers who would have less access to additional capital. But of course, we're still looking for creative ways to serve more customers, right? Whether that be through lower balance lending if we could, whether that be through other products that we're exploring. Like, it's true that has been an impact that is touching Canadians, and it is a direct consequence of the regulatory change. And it's also true that we will look for creative ways to continue to solve that problem, and I think we'll come up with many in the years ahead.
Yeah, so I mean, that's, I guess, continuing that, and this is probably more, again, a question for Jason Appel, who's head of risk at your shop, and you're going to be speaking this afternoon, I think, on this. But, how do you as a non-prime lender balance growth, risk in a cooling economy? Like, you've got uncertainty, you have inflation, you have shifting debt. How do you balance all that?
Yeah, the company really set itself up for success coming out of the pandemic, right? Having a strong business model is what enabled the company to acquire LendCare in 2021. Right. And so a lot of growth that's come post-COVID era for the company in the face of worsening credit wasn't from a credit box expansion. In fact, we've been tightening our credit box on legacy products. It came from unlocking new product verticals altogether, right? So not needing to expand the credit box, but actually picking up more share in lower risk secured product types, right? So it's been, for us, the fact that we had set up a strong business that we could capitalize on dislocations created by COVID really created that perfect mix of products and underwriting for us to grow through a pretty tough period.
Got it. Again, ruggedizing, a little bit like your short report is ruggedizing you. It's good to have some headwinds. So let's get back to the perception challenge that we tackle all the time at the CLA. You mentioned you have 400 stores. How do you maintain and build trust with customers and the public? I know that Jason used to spend a lot of time sort of walking through the stores and speaking to customers. Like, how do you go, how do you tackle that onward going perception challenge that we face? Are there any tactics, strategies that you have?
Yeah, I mean, I gotta be honest. Like, coming into the organization, I probably carried some of those perceptions as well. And the thing we ask everyone to do who's coming into the company and who continues to be inside our company is to spend a bunch of time inside the branches with our employees. Because once you do that, you get a sense for how much they care about the customers that they're serving and the ownership mentality they take around ensuring they're building sustainable relationships with customers that we can safely lend to. And if I go and sit in a branch for an hour and talk to the staff, the chances of someone walking in the door that 3 of the staff members get up and give a hug to is like 95%. Like, it's quite amazing. So that community-based model is really about customizing and developing personal relationships that ensure the interests of the company and the interests of the customer are aligned. And the challenge becomes, Gary, of course, like, how do we tell those stories more broadly?
Right.
And the most powerful versions of those would be individual customer success stories. But as you know, that's not necessarily something that most customers want to do. So, we do this cool thing every year in our conference where we have a customer of the year and we talk about one smashing success customer story, and that customer films a video with our staff, and like everyone ends up in tears. And that gets my wheels spinning in terms of like, how could we bring more of this to light in the public domain so that people can see these are real people who have real needs, who have been served really, really well. And it's something that we should be embracing and celebrating and supporting versus saying, I don't get it, I don't understand it, it must be bad.
So I don't know if you can speak to this, but the new government, do you think they have more of a handle on this ecosystem that we call lending in Canada? So, what we always talk about, and I'm sure you do as well, is that, lending is contiguous, right? You graduate somebody from goeasy, they go to somebody else, and eventually, we hope they land up, in a bank somewhere, and that's the journey. And it's a contiguous sort of journey. And I had a hard time working with the ministry and working with the powers that be in telling that story.
Sure.
Do you think this government is different?
Well, I would say I think we believe we're having productive conversations right now. And the challenge is always going from a productive conversation to a concrete action, which is also true inside organizations. So I think we have a fair amount of optimism about the current regime and where this could be going, and that's not to say anything about any previous regime at all, right? So the important piece, Gary, of course, is that we don't lose energy and we don't lose focus, and we just kind of keep going at it. And from my seat, it sounds like we're making some progress here. Yeah, I could talk about the previous regime, but I won't. So what's next? Let's round off. Let's talk about what you see next with goeasy. What are you looking, not only with numbers but services? Like where are you heading? Yeah, as I mentioned, the North Star is really stitching together that one-stop shop for credit for non-prime Canadians. It's $200 billion plus market, which we've got less than 2% of. We're not in all the product verticals that I think will eventually. Well, let's talk a little bit about that. What product plans do you have? Yeah, the ones that we've been exploring internally are direct-to-consumer on the auto side, including kind of the refinancing business. We've been exploring credit card as an option for the direct-to-consumer business as well. So those are probably top of the list right now. Got it. We probably have 2 minutes for an amazing question from the crowd. No pressure, only one really good question. Yeah. Any amazing questions from the crowd? I asked all the amazing questions. Yeah. Well, thank you very much. I do appreciate it. Thank you, Gary. Good chat. Appreciate it. Thank you. Thank you.